Today, inflation, deflation, which comes first? Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and property news with a distinctively Australian flavour. It's Friday and I'm joined by Tarric for our Friday afternoon chat. Hi Tarric, how are you going?
Not too bad, Martin. How are you?
I'm pretty good. It's Friday again. So much going on though. I tell you what, I'm swimming in data at the moment.
Yeah, so am I. There's been quite a lot going on recently. A lot of different data releases, a lot of surprises for the analysts in pretty much every single way. And I recently saw your live stream with Tony Locantro, and I was inspired by his slideshow on how he sort of sees how things are going to play out. So I've just made one of my own, which I thought that I would share with our viewers.
It sounds very interesting. And yeah, Tony's got his slide shows down to a fine art now. So I'll see whether you're up to the same standard. I'll give you marks out of 10 at the end, okay?
All right, well, you might have to grade me on a curve or something here because I think that Tony's is probably going to be quite a lot better than what I've thrown together, my little just, parade of charts. Here we have the inflation versus deflation presentation, as I like to call it. So we'll just fire this up. Basically my sort of feel on things is we've got a sort of why not both situation because we've got various different factors both pushing and pulling in versus the short term versus the long term. So I think we could end up with a lot of excess capacity, but I'll sort of let the slides speak for themselves. So you're all still there, Martin? We're all ready to go?
Yeah, go for it.
All right, sweet. Now let's just... Well, we've seen recently the US CPI printed its highest level since Ronald Reagan was president. So it's clear that inflation has arrived. But the question is, why is it here and how long is it really going to stick around for? We've seen record demand for goods, going through the roof as a result of the pandemic, and services spending still remains depressed across much of the world. Now, this is especially true in countries, say like India, and other places that are struggling with the pandemic quite badly. And we've seen, as a result, especially with the middle class and in nations that have had high levels of fiscal stimulus, the spending on goods has gone absolutely through the roof. And in this sort of modern, just-in-time supply chain type world that we live in, it's had an outsized impact on the manufacturing sector and on shipping, as I'll show in the next couple of slides. We've seen the cost of shipping, in particular from China through to the US and through to Europe, skyrocket by more than triple since the middle of 2020. And it's interesting when you actually look at shipping more broadly, say shipping from Europe to the US or other sort of less, sort of more traditional routes, shall we say, the cost pressures are much, much, much lower than they are in terms of things especially from China to the west coast of the United States, because we're seeing big, big backlogs of both containers and of just freight more broadly. And that's really just driven up prices of shipping and basically anything else. And Martin, if you've got anything to add, just feel free to just, throw anything in.
I'm just sitting back and watching, Tarric, but if I have something to add, I will.
No worries. Well, as I was saying, with the issues as a result of shipping issues and as a result of that enormous demand that I previously mentioned, we've seen the lead-in time for production materials go through the roof for US manufacturers to the highest levels since records began back in the late 1980s. Now, as you would imagine, this level of demand still hasn't, it still remains. So this level of pressure on manufacturers continues and is one of the reasons why we are seeing further issues with manufacturing output. As this slide shows, the production of US motor vehicles is actually at roughly the same level as it was in late 2014 as a result of the microchip shortage that's current, or semiconductors, depending on what you prefer to call it, that's still hitting the world quite badly. Now, this is arguably the poster child for the issues with the manufacturing sector and the economy more broadly when it comes to the supply chain problems. Because if they continue, even though you're going to see all these nice GDP growth numbers and all these various things based on the inflationary impact and the rising prices, in terms of the actual industrial production and the actual individual sales of products, things might actually look significantly worse in reality behind all the flashy numbers. But that's really something that we've seen a lot more recently. And these supply chain pressures are in anything from literally the little granules they use to make plastics all the way up to things like, well, super tankers, which are in high demand.
Tarric, I'll just come back. If you put that other slide back up again.
Yep.
I just want to make one quick point, and that is, what's interesting? You see this drop here, which of course was March last year, right? The old base effect, right, is just worth reflecting on, right? If you measure anything from that point to there, it's a huge upward increase, right? But that is going to contaminate all of the statistics for quite a few months because of these big drops back a year ago.
Yeah, absolutely. Absolutely. And that's also something that people should keep in mind more broadly when looking at manufacturing data and really any data from this period, because in those months that followed during this big bounce back, you are seeing the result of this demand, which completely cratered and basically ceased to exist during lockdown. And that's now slowly feeding through the economy. And this is something that's been particularly keenly felt once again with the auto sector, because there just hasn't been the demand, there hasn't been the supply to keep up with that demand. As a result of this demand for goods and also for just commodities raw material, shall we say more broadly, we've seen US producer prices rise to the highest level in quite a long time. And based on some of the prices paid sub-indices of things like, say, like the Philadelphia Fed Manufacturing Index, we're seeing things at the highest level since Jimmy Carter was president, which was over 40 years ago. But the question is, are these sorts of pressures going to last? While there are some pressures building on wages, which could make this inflation more protracted, as Martin and I have previously discussed, so far there isn't really a whole lot of willingness from small businesses and businesses more broadly to raise wages to start filling these jobs, mostly because there is a general belief that this is transitory, that as people go back to work, that as these additional unemployment benefits and additional layers of support from the government begin to slowly evaporate as they're scheduled to end, both in June for some states which have decided to end them early because of issues with the labour markets, or September when they're actually scheduled to end. There's just this sort of wait and see thing where where there are quite a lot of anecdotes out there of people going to restaurants or to other venues which are generally populated with low wage or minimum wage workers, where they're either just keeping them running on a skeleton crew or just not opening at all because they don't want to make a long-term commitment to raise wages. Now, this was explained as one of the main drivers in last month's non-farm payrolls report, which came in very, very poorly. Sorry, I think I missed including a slide. But I'll just finish what I was saying. But basically, it's all well and good for people to say, but people on lower incomes are not going to go get jobs because they get more money for sitting on their ass at home. But if you actually look at the demographic breakdown of US income deciles and how it's distributed, only roughly the bottom quarter to maybe the bottom third, depending on the state, is there's actually any real incentive to sit at home and do nothing. And I think that's a little bit of a furphy in the sense that I think a lot of people who've been unemployed now for quite some time would much rather have the stability of a job than hoping that the government continues the freebies and the handouts after September. Anyway, back to the next slide. These supply chain issues are generally seen by the Fed and others as transitory, as something that's just going to, go away within a relatively short period of time. And to a degree, in certain industries, that's very much the case. But in things like, say, semiconductor manufacturing, microchips, it's a much different story, because building the capacity to manufacture microchips takes a lot longer amount of time than it is to just make another plastics or widget factory that makes, just the usual sort of stuff that we see on our shelves that are made in China. And even here in Australia, even this month, we're still seeing retailers with supply chain issues. Now, these supply chain issues are also proving quite distortionary, in the sense that there are a lot of companies, whether it's a builder ordering lumber, or whether it's even just a hairdresser ordering dye, as I've heard from some people recently, who are now making additional orders to stock up on these products and on their inventories, to make sure that they will have the products that they need. But by the same token, this is bringing forward a lot of all this demand, and this is creating an incredible distortion in the data of how much demand there actually is out there. And this is really something that isn't well examined. And it's something that actually the CEO of ARC, Kathy Wood, mentioned the other day in an interview with Bloomberg. Now, while I disagree with Kathy on quite a few things, when it comes to the fact that this is going to end up creating excess capacity, I can't help but agree with her. Now, despite the sort of very positive narrative out there that the US economy is roaring and that it's all going to be fine forever and ever, and that the Fed will save us, if you actually look at the data, what's Citibank called the hard data, which is things like retail sales, non-farm payrolls, manufacturing indices, etc., they've actually been surprising to the downside for quite some time now. And US analysts and Wall Street analysts and analysts around the world haven't cottoned on yet that maybe this is part of a trend and not just a blip. Now, it could be. They could be right. I think, that's well within the realm of possibility. But as I'll show in the next few slides, it's not just a single thing surprising to the downside. There's quite a lot of indicators that are not so favorable. Despite this sort of positive narrative, if you actually look at the internals of things, say like the U.S. Retail sales report, you're seeing that a lot of this pent-up demand, even for things like food services and bars, has actually already more or less returned to normal. So while we may see a sort of, big blow-off, big bender that during the Northern Hemisphere summer, it's not really going to be that big of an enormous bounce back as if it had occurred in, say, May or June last year, when a lot more venues were closed. And if you look at things like non-store retailers and online retail, for them to revert to mean, you're talking about, drops of 20 or 30%. Now, while a lot of these retailers will continue to do well, and online retail will continue to grow, more broadly relative to bricks and mortar, a lot of that growth has already been sort of priced in, and that's also priced into the share market as well. Now, as I mentioned previously, there is enormous overcapacity building at the moment, and I've spoke to shipping analysts about this who share this view that for the first time since 2008, shipyards around the world that make these enormous bulk carriers, super tankers, and box ships like the Ever Given that got stuck in the Suez Canal, these shipyards are now completely booked out until 2024 for the first time in 13 years. And this is going to create enormous overcapacity in the shipping sector. And this is exactly what happened prior to the financial crisis. You saw this enormous demand for shipping, and then you saw shipping indices eventually crater after the Chinese stimulus started to wear off. In April, despite, well, shall we say, very high expectations that the US would create 1 million jobs, it created just 266,000. Now, while this is obviously, surprise to the downside, it's the magnitude of the surprise to the downside that has really shocked some people who are paying attention. Now, there's all sorts of various narratives out there. Oh, it's because people don't want to work. It's because of X. It's because of Y. But the interesting thing is, when you look at the March numbers, which were impacted by all the various weather events in the US, the blizzards in Texas, all these various, quite frankly, large events that impacted employment growth. The fact that the numbers are even worse than that does ring some alarm bells. Now, while it's only 1 month and 1 month doesn't make a trend, this is just one piece of data among many that is pointing to some concerning signs. This is the chart that I was looking for. This shows that if you're in like the first quartile of income earners in the US, then chances are sitting at home collecting, $500, $600, $7 a week from the government may hold some appeal if you're that type of person. But once you get towards the second quartile and you head up to, out of the low income earners, the appeal sort of very much disappears. And the reality is we live in a world where you have to pay bills. And while those bills have been, deferred in some cases and even just flat out cancelled in others, I don't think that many people are silly enough. That larger proportion of people, I should say, are silly enough to just kick back and hope that Joe Biden keeps handing out the goodies. In terms of consumer sentiment, it was the biggest miss on our analysts' expectations in the history of analysts' expectations for consumer sentiment. And this surprise to the downside really, really shocked quite a lot of people because the economy is reopening. Everyone's getting vaccinated. 60% of Americans or something along those lines are vaccinated. But despite all of these improvements in quality of life and people being able to go out without wearing a mask, things really aren't that good for American consumers. They just don't seem all that impressed by it. One of the theories put forward, and is one of arguably the most common one, is that inflation expectations have risen to the highest levels since 2011, and consumers are concerned that their buying power is being eroded, particularly at a time when things still are so uncertain for so many. And even prior to this rather sizable fall in US consumer sentiment, we were still well below the levels of pre-COVID. And as Martin and I have discussed previously, a lot of the boost that consumer sentiment indices have enjoyed over the last few months is a result of doing better with containing the virus and the way that households are reacting to that, rather than the broader economy really starting to impress them. Now, one of the really interesting internals of the University of Michigan's consumer sentiment survey is that despite all this demand, despite all empty used car lots in the US and enormous demand for homes, the conditions as consumers see them for making these purchases have dropped to the lowest level in 40 years. And this is something that we're seeing in Australia. It's something that we're seeing in the UK and around the world, because basically consumers are a bit uncertain about the future, but it's also the fact that the cost of vehicles has risen. The cost of used vehicles has skyrocketed in the US. The cost of housing has skyrocketed. And now people are just saying, no, I'm not going to transact. I've had enough. I'm just not going to do it. And that's something that Martin and I have discussed. That's evident in his surveys. And it's also evident in the time to buy a dwelling index from Westpac. U.S. retail sales growth in April, yet another one that disappointed, was a big fat zero, which didn't surprise some people, but it certainly surprised the market, which is now getting increasingly concerned that a stagflationary scenario may be possible. If you actually look at the control group for U.S. retail sales, I'll just move this so people can actually read it. In terms of the control group, it's only risen strongly in 2 out of its last 7 outings. And this is the months when enormous levels of stimulus checks were rolled out, when hundreds and hundreds of billions of dollars were thrown at Americans, and they got out there and they spent up big. But the moment that stimulus starts to fall away, all of a sudden, so does retail. And that's something that US retail and Australian retail is eventually going to have to confront as the stimulus feeds through the economy, as that fiscal impulse fades, and perhaps more importantly, services spending begins to resume at normal levels, and we see the reversion of that initial chart I showed, which I believe was the second slide, which showed how elevated goods spending was. This cycle, the US recovery is key. Ever since 2008, the Chinese economy has been the growth engine for the global economy. Its debt expansion, its fiscal impulse has been its credit impulse has been one of the key drivers of growth around the world. As you can see from this chart, when you chart it against the global manufacturing PMI, the Chinese credit impulse is the global manufacturing PMI. And while there's obviously quite a lot of different factors at work this time, which may blunt, shall we say, the relationship between the Chinese credit impulse and global manufacturing, the reality is that it's rolled over quite significantly, and it's continuing to, because China is no longer is trying to rein in its debt levels. It's trying to, well, what did President Xi say? To prepare it for a black swan event. And that's something that we're seeing at the moment with higher levels of bond defaults for Chinese corporate entities, even state-owned enterprises, occurring at the moment. The result of all this in the short term, quite possibly stagflation. Because while we will see strong growth in the US and elsewhere in the latter half of Q2 and parts of Q3 in the Northern Hemisphere summer, as all this various stimulus is still feeding through. I mean, there's still more stimulus to come in Europe, as all the various European parliaments approve that these stimulus these broader EU and ECB stimulus plans. But by the same token, these are temporary things, and you can't solve supply chain issues and shortages which are driving higher prices with stimulus. Conclusions. Basically, while a lot of people think these supply chain issues are going to be resolved quite swiftly, there is a potential that they could persist for quite a long time. And these issues will eventually reverse, because as all these companies build all this excess capacity to take advantage of these higher prices, as these ships are built to ship all this stuff around the world, you're going to eventually end up with factories sitting idle and enormous inventory builds as all this demand begins to fall away. Because at the end of the day, you only need one PlayStation 5. You only need so many consumer goods. And a lot of that demand has already been satiated. Now, just a bit of a caveat about all of this. There are things that could occur that could blow basically everything I've said to bits. You could see rising geopolitical tensions between the US and China, which could create reshoring of supply chains and relocations of supply chains to other parts of the world, which could increase costs, which could support the inflationary impulse. There's also the possibility that they're just going to do trillions more stimulus all over again. We saw at the end of last year, all the stimulus was meant to fall away in Australia and in the US. It was meant to be, the JobKeeper was meant to end in September. The US was meant to kick its stimulus habit late last year, but then Trump threw nearly $1 trillion more at the US economy, and then Biden came in and threw nearly $2 trillion more. So that could all change quite quickly. As Martin and I previously discussed, I think that inflation is going to continue to scare the market, because if central banks raise interest rates, the whole thing could come crashing down quite swiftly, and it wouldn't be the first time that happened. Now, while there are a lot of forces supporting inflation in the short term, things like the short-term pent-up demand in the Northern Hemisphere, other countries that have been in lockdown, the fact that we are going to have supply chain issues potentially to as late as the first quarter or second quarter of next year for things like microchips, there are currently relatively few potential inflationary drivers in the long term, but there are a number of deflationary forces, things like bills that need to be paid, and and governments to turn down the taps of stimulus, and that's something that Martin and Steve Van Meter have discussed quite extensively. And it's hard to see how without one of these major changes that I previously mentioned occurring, how these deflationary forces are going to be overcome in the short term. Now, if the Fed goes full debt monetization or QE to the moon or all these other different things, then it's different. But at the end of the day, we can only talk about how things are today and speculate on how it's going to go in the future. But yeah, that's it.
Terrific. Well, that was very interesting, Tarric. Thank you very much. And what I find fascinating about that is that it pretty much echoes my own analysis, which is that all of this talk about inflationary pressures are missing the transitory nature of a lot of them. And of course, the Fed has been saying that. In fact, the Reserve Bank and even the Bank of England has been saying that. The question then is it deflationary or stagflationary beyond that, right? And there are some examples where you can say, well, very low interest rates is intrinsically deflationary. Quantitative easing may be stagflationary, or it might be deflationary, or it might be inflationary, but it depends on what happens with the money. So it does come back to exactly what you say, which is, so what is the Fed going to do? Are they going to keep going? And there was an interesting thing in the minutes, which of course scared the markets earlier in the week, when they actually said, well, maybe we're going to actually see them talking about rolling back quantitative easing sooner than people expected, which of course put everybody on alert. So, I mean, a lot to play for, but I just don't think that the conditions are there for the same significant inflation that we saw in the 70s. And of course, wage inflation, which is the one I come back to all the time, wage inflation is nowhere even now. And for me, unless you actually start seeing wages running significantly ahead of everything else, go away. Sorry. Unless you see everything, changing significantly from where we are, I think wages are going to stay very low for a long time. And of course, the Reserve Bank here has said wages growth nowhere for the next 4 or 5 years in real terms. So, yeah, I tend to think that you're on the nail there in terms of precisely how this could play out, which is not good.
No, unfortunately, it isn't. I think that we've really painted ourselves into a corner, more broadly, to be completely honest. Like, central banks have completely gone ape with their levels of monetary support, with quantitative easing, with all these various different things. We've seen, and perhaps more importantly, we've seen peak support from the fiscal side of things. I mean, if you look at things like the Victorian state budget, you're starting to see this revenue being clawed back to fund all these various policies. Things like raising payroll taxes, raising property taxes, raising stamp duty. All these various different things are, they're inherently deflationary. You can't suck money out of the economy when it's still very weak. I mean, and it is very weak, despite all the various fanfare and everything from the RBA and from the government and from the media. Because at the end of the day, we've still got $100 billion a year deficit. And I think it's important to keep in perspective that deficit is double the entire Rudd-Gillard stimulus policy. And that was spread out over 3 years, not over one.
Well, you're right. And yet, of course, the budget this time around is just throwing more money at lots of different things, none of it which is strategic, as we've discussed on a number of occasions, right? It's basically get me out of this political cycle into the next one and try and win the election is the strategy in the budget, right? There's very little long-term investment there. There's very little strategic investment. But Victoria is sort of signalling that they're going to have to start thinking about clawing money back from somewhere at some point, okay? Putting stamp duty up, putting more taxes on corporates, those sorts of things. None of that which is going to actually increase the momentum in the economy. So it's going to be an interesting ride ahead.
It really is. I think that these problems are legion, and they are the same pretty much all over the world. We've spent our way out of trouble. We've spent in Australia, in the words of Alan Kohler, it was stimulus overkill, and I tend to agree with him on that. Now with the luxury of hindsight, although I think that anyone with, well, how do I be kind? Anyone who is smart enough could see that in probably June last year or July that giving money to all these companies through JobKeeper, who were seeing roaring sales, who were making more money than ever, could see that it was going to be too much and that it was going to be unnecessary. And without getting into the politics of that has benefited the economy enormously. Now, one thing I think is really interesting is that in 2009, Treasury did some predictions on what would happen to the economy as the Rudd government's stimulus, well, Rudd/Gillard government stimulus, was slowly withdrawn in terms of the impulse of government spending and its impact on the economy. And the impact was going to be significant. It was going to be something like the withdrawal of that level of stimulus was going to hit something like 60 to 70% of its total impact was then going to be sucked out in terms of the lower GDP growth. I haven't seen anything like that from Treasury this time, mostly because if there was anything like a 70% pullback, you're talking about 10% of the economy just disappearing.
Yes, well, they don't want to talk about withdrawal too much, right? Because essentially they're only interested in the next 12 to 18 months, I suspect. But it does beg the question, can you actually turn it down? And if you do turn it down, what happens? And remember, of course, that last time around, they didn't have the same pay freeze for the public sector that they got this time, as I recall. So, one of the factors that I think people are perhaps missing the point on is that the pay freeze in the public sector, they're still wanting to put it through, right? They're not. So it's an interesting contradiction, right? Because on one hand, the government's saying, well, we need to get wages growth up. And of course, the Reserve Bank says we need wages growth up. But then public sector pay is frozen. Square that one for me.
Raising public sector wages is not a popular thing. I think it really is that simple.
Oh, you mean it's about the political perspective rather than the economic perspective? Well, that's a surprise.
Oh, I'm shocked. Positively shocked. You just wait until the next federal budget after the next election.
That will tell us where we really are, won't it?
Yeah, it will. Yeah. Because this budget is just God. It's an election budget. Yes. Everyone's saying, "Oh, Scott Morrison could wait till next year to do an election." Could go right up to May. I doubt it. He's not gonna want to have to do that. But just going back to what we were saying about just the broader situation, just before I forget, the thing is, we talk about how, well, not so much us, but just the media more broadly, the financial media talks about, we're out of the woods, we're heading forward, we've got this recovery going, and it's all going to be fantastic, and blah 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 blah. But the thing is, there are so many issues in the system that people like, say, Stan Druckenmiller have noted, and him and numerous others. Talking about legendary billionaire investors who've been doing this sort of stuff, almost just twice as long as I've been alive, and these people, they know what they're talking about. They know that there are risks. And it's all good for people to say, okay, but they're not going to happen. They're not going to be realized. But we need to actually talk about these scenarios that could be realized, that are well and truly plausible. And that's something that's been really interesting over the last week or so regarding the reverse repo situation. The Fed is doing its largest level of intervention outside of quarter-end rebalancings since, ever actually. And even people like Zoltan Poznan, who is the repo king, who understands the plumbing of financial markets and all the back-end stuff better than anyone, is basically saying that this could force the Fed to end QE early because there's just too much bank reserves. And it's negatively impacting the system.
Yeah, I think the repo stuff is something which hasn't been that well covered, I've noticed recently. And it was covered, last time around when it got to these heady levels. But you're right, they're doing more, and it is, of course, a significant impact because what it is doing is supporting the financial system, right? And I think we have to come back to this to remember that the Federal Reserve and the other central banks are most concerned about financial stability, in fact, more concerned about financial stability than anything else, right? So they will do whatever it takes, and they will throw whatever liquidity in whatever form they need to try and stop things falling over. In other words, financial institutions in particular have a government-backed guarantee that is cast iron and watertight. Right? Never mind what it costs the real economy, never mind what it costs real people, right? Now, they can do it because, of course, they can just move the assets and liabilities apart more and then create, the borrowing one side or the other and then create more assets and throw it out there, which is how they're doing it, right? But it is a really, really weird situation where you can do that to infinity to support the financial system. But the amount of support that's going to the real economy, well, we've had the two stimulus packages, is going to come off. This is not a healthy economy.
No, it's not. And it's creating these enormous levels of risk because, you create this situation whereby what does the Fed do? Do they keep going with QE long after the US banking system has passed its ability to be able to adequately process and hold these bank reserves, and basically the Fed just ends up as this, giant cyclical, I don't even know what you call it, just this giant perpetual motion machine of money of bank reserve printing and of just injections of liquidity, and then the banks just turn around and park those reserves at the Fed anyway, and at the end of the day, there's no benefit to the real economy, and more risk builds around financial markets more broadly and around the US economy and the dollar in particular.
And you've made the exact point that Steve Van Meter keeps making, right? Which is that the Fed creates more liquidity, but it then goes back and gets locked up in the bank reserves at the Fed. So it doesn't flow into the real economy. In fact, the banks aren't lending particularly strongly. I mean, mortgage lending's up a bit, I think, in the US, but there isn't the real lending to business. Okay, businesses are actually going to the bond market and issuing bonds and buying back their own shares. That's another problem. But the quantitative easing machine is effectively inflating the Fed's balance sheet, inflating the bank's reserves at the Fed, right, of assets and liabilities. And that's all. It's an artificial construct that's getting bigger and bigger. The numbers are getting bigger, but it's not necessarily supporting the real economy. And that's the problem that I keep coming back to whenever I look at this.
Yeah, and exactly. And it's not just the Fed either. In Europe, it's arguably even worse because they are buying these bonds at yields that the market isn't interested in buying. There isn't sufficient demand to buy those bonds at those yields in this environment. I just, it kind of boggles the mind in a way that there are people out there who, that people think that they would rather lend money to the Greeks, who, let's face it, could default at any point in the next couple of years if there is a major schism in the ECB or in the EU more broadly, particularly with the German and French elections coming up. You've got the German Greens potentially going to set to take power if the polls get realised. You've got Marine Le Pen in France and her Euroscepticism. If France pulls out of the euro, Jesus Christ, could you imagine what that would do to the joint? But there are all these various risks and nobody talks about them. We just keep talking about, oh, this has gone up, that's gone up, isn't it fantastic? Housing prices to the moon. But I think, like you were saying with the real economy, what gets me about all this stuff is that we live in a world where, generally speaking, if someone wins, someone else loses. Now, if you're say just the QE situation, if you're a young investor and you're trying to get into the stock market and you're trying to build wealth, you are struggling to buy into this thing at anything approaching the same rate. So at anything approaching the same price, index to inflation, wages, per capita, yada, 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 adjust it any way you want. It's more expensive to get in and try to start to build wealth, which just increases inequality. And that's something that Stan Druckenmiller said the other day. He said that the single largest engine of inequality in the entire world is the US Federal Reserve.
Well, yes, and those statistics, I think I showed them on a show some time ago, where you looked at it in the quintiles, the 10%, right? The top's got a bigger share of the total, right? And I think half of the US is sort of right down the bottom, right? And it's got more extreme, and you can pretty much track the more extreme movements based on the quantitative easing and all of the injection of liquidity that the Fed has done. Because essentially, yes, we keep coming back to this polarization of the few that have a lot and the many that don't have very much at all. And look, it's not surprising then that people turn around and try and grab onto different ways of trying to create wealth, be it trading cryptocurrencies or trying to get into the housing market, because, you know, they want to sort of have a bit of a share of the action. Unfortunately, the risks are much higher than they were, and their ability to be able to enter the market and hold and grow in the market has been considerably eroded. I'd also make the other point, your point about for every winner there's a loser. That's true at an individual trade level. So, for example, if you are buying a crypto, somebody else is selling the crypto, or vice versa. It's always worth just thinking about who's on the other side of the trade, right? And the people on the other side of the trade could well be those with more advanced intelligence about what's going on, the ability to see the dark pool markets early. All of the high frequency trading stuff goes on in sort of relative secret. So quite often retail investors are actually at a natural disadvantage to everybody else to start with. And unfortunately, I have a feeling that many retail investors who think they're actually, smart and trading well, are often trading on sort of second-hand information, on second-hand trades. They often lose out. And that's something which, again, many people don't want to talk about. But for me, that's, again, the basic inequality of the financial markets.
Yeah, and it's always retail that gets left holding the bag. It's retail got left holding the bag in 2008. They got left holding the bag in the dot-com bubble. And now we've seen the biggest equity inflows. We've seen more equity inflows so far this year than we have in the previous 12 years, including 2020 combined. And these are absolutely insane numbers. We're talking about, trillions of dollars. Well, it's actually about 1.3 trillion to be specific. But you're talking about an enormous amount of money, more than 6 times what was injected last year. Sorry, actually 5 times, in fairness.
Yep.
But, you're talking about an enormous amount of money. And people say, there's all this money on the sidelines. It's like, well, is there? You've seen more equity inflows in the last 12 years than you have in aggregate over, in the past 5 months than we have in the entirety of 12 years. And people tell me there's all this cash on the sidelines. I think there are probably some very wealthy, very intelligent, well-connected people who are waiting for everything to fall to bits. But I mean, you even look at like the curve of options futures for the markets, that they're curving down, they're not curving up. And I don't know. It's hard to listen to people like Druckenmiller talk about this whole thing blowing up, the whole market blowing up before inflation becomes a problem. Because, I mean, in a way, a market blow up is now a perfectly legitimate central bank tool, if you think about it, because they can't raise interest rates. That would blow up the bond market. That would blow up everything. If they raise rates significantly, sort of 2, 3, 4%. To crush inflation, but you can equally crush inflation by just letting an asset bubble burst.
Well, that's the old Great Reset theory, isn't it? And I sometimes say, well, the economy is not control delete, right? We need to sort of restart it because you can't perpetuate this without actually just continuing to do the same. If you try and change, so either you stop the quantitative easing or you deal with higher interest rates. Both of those two levers will create mayhem.
Yeah, but that's where we're at, though, isn't it? We're at this. We're stuck.
Yeah.
People talk to me as like, we're just going to muddle through. We'll muddle through. It's like, well, look, you're either going to end up in an inflationary future where you're going to have inflation eating away at the fabric of society like a moth, slowly eating away until finally something structural breaks, or you end up with the fiscal stimulus not being enough. And then you just end up back where you started with an economy that needs serious reform. And I'm not just talking about Australia, I'm talking about the US and the Western economies more broadly, generally speaking. And they need reform. They need, and I know that this is a matter of contention for a lot of people, but you could talk about, cutting red tape. You could talk about incentivizing innovation in entrepreneurship, tax-free, tax advantage zones, infrastructure spending, you name it. there are a lot of different things that I think we could all sit down and come to a positive conclusion about. But no, we'd much rather just throw money at bullcrap programs, and like they have in the US and in Australia at JobKeeper and at everything else, and just waste money on crap that does nothing but provide a sugar hit to the economy in the short term, but does nothing structural to change the issues that we have.
Well, I've said before that all those billions of dollars, if they'd been spent over there doing something strategic and long term, we could have actually had a very different economy than the one we've got. But nobody wants to talk about that. And I have to say, even Labour's response to the budget was just sort of around the edge, nothing really strategic there either. So I'm afraid neither side of politics wants to actually make those strategic reforms for the economy. But they're happy to talk, till the cows come home on, small little tactical things, which may be important. I'm not saying they're not, but not necessarily as a relative priority to doing some of the more structural things that we need. And, we're not the only economy around the world. And I just remind you, Japan has been at this longest. So the quantitative easing programs have been there in Japan the longest. They've still got deflation, not inflation. They've got negative interest rates. They've got 100-year mortgages. And they've got an economy which on one perspective is looking quite okay, but actually from another perspective is not going in the right direction at all. So, even if they continue to do the same in the US and in the UK and in the Eurozone and in Australia, you wonder if it's going to actually pay off. And I'll make this point, that the amount you have to go on injecting through quantitative easing is not linear, right? You actually need a logarithmic increase just to keep the status quo in balance. So by definition, if you've put 100 million in this month, in a year's time you've got to put 120, 130 million in just to make it the same. So that's the point that people, I think, may need to recognize, right? This is not a linear thing. You've got to just do more of it and more and more. And at what point do you say, we've had enough, we can't do any more? That's the really interesting question. And who's going to make that call?
Well, I think it's as equally true of fiscal policy as it is of monetary policy. I mean, you look at the US at the moment, they're running a deficit that's larger than all federal tax revenues. There is real, I mean, from a purely sort of, realistic perspective, I mean, can you imagine them doing even more stimulus than they already have just to keep the plates spinning? I mean, you'd be talking about a government that is spending not only double what it takes in, but more than double, trillions more than double. And it truly boggles the mind that even like people say to me, oh, but look at the recovery, look at this, look at that. It's like 1.56% quarter-on-quarter GDP growth is a crap result after nearly $3 trillion in stimulus. I'm sorry, it's garbage, and I mean, it's a similar thing here in Australia, like even say just with the property market, everyone goes, oh, well, you were wrong. And I'm just like, sure, yes, I was wrong. Hand up, wrong. Absolutely. I didn't think that the Liberal Party would completely abandon fiscal conservatism in the way they have. I didn't think that there would be enough right-wing people who were capable of the mental gymnastics required to justify continuing to support this type of idiotic levels of spending, which is done a great deal of the time on crap. And I didn't think that they would spend $700 billion on supporting the system, which is, I mean, what do we have to show for it aside from rising housing prices?
Well, you have a treasurer who's now found the visionary idea that unemployment should go lower.
Oh, well, then we get into the whole MMT thing, let's get to full employment, let's do it regardless, blah, blah, blah. But look, I kind of like the idea of MMT conceptually. I like the idea of using government policy to drive positive outcomes. But what we've seen in the last, 15 months, 14 months, 15 months, whatever it is, it's a nightmare. I mean, look at what they've done. So we're gonna use MMT, we're gonna print money, we're gonna monetize debt, we're gonna do all this stuff, and then we're gonna give all the money to Jerry Harvey. and then we're going to give, what do they call them? Paycheck protection program loans to billionaires and Wall Street, so they can all never pay the money back and spend it all on Lambos. That is the problem with MMT. We can talk about the conceptual stuff and how all the plumbing works and all that other sort of stuff as much as we want. But as long as you have people like Donald Trump, Joe Biden, Scott Morrison, Boris Johnson running the show, they're going to spend it on garbage.
Yeah, and that is really the point, right? So the MMT makes, I think, a good point, which is that you can't necessarily think of a government balance sheet the same way as a household balance sheet, particularly if you have your own currency and therefore can use that to be able to actually create a pool of value. But the critical question is, what do you do with that pool of value, and can you invest it in a way that generates superior growth and returns and therefore employment for the population, right? That's the other balancing argument within MMT, right? If you don't do that, if what you do is just spending on tactical projects and buying the next election, which is what's happening, I think, at the moment, then effectively you've just completely eroded the fundamental philosophical point of MMT. And whilst the size of the debt may not be as much a worry as in the neoliberal school of motoring, the fact is that once you've done the MMT cycle once, if you're going to do it again, then you're just going to incur yet more debt. And unless you actually have a different investment plan and a different investment strategy targeting the right things, you're going to get the same outcome again. So I'm afraid I come to the conclusion that whilst MMT is probably worth exploring and thinking about, the execution through this particular cycle of government is appalling. And yet nobody wants to take ownership and responsibility, and everybody's just saying, well, that will give us a platform to win the next election, won't it? Because we're going to take the unemployment rate down, and we will spend whatever it takes to get the unemployment rate down. And the Reserve Bank can say, well, we don't have to worry about low interest rates and house prices because we're going to get unemployment down. So, even if house prices go up, it doesn't matter because our prime objective is to get unemployment down. Well, I'm sorry, I am not convinced by that argument, because the strategies that are coming beyond that are not actually answering the call of what you need to do to get unemployment down and to create the economy that we need for the future.
Exactly. It's all about the leadership and the execution. Now, I'm not going to get into how MMT may or will not work conceptually, because that's something for an entire video in terms of getting into all the things of how it all works, how a monetary sovereign works, etc. But as you say, it is all about the leadership. I mean, let's say, for example, that you and I are wrong about this, the issues with deflation in the long term, and it is an inflationary future. Let's say that is the case. We've gone full MMT. Basically, you've got a $3.5 trillion deficit in the US. They're basically, they are monetizing debt. Let's be honest, and at least not entirely, but not all of it. But they are monetizing some debt. And you look at it and you go, okay, inflation is rising. Inflation is potentially heading to the point where it's going to be out of control. Now, I don't think that's going to happen, but let's just say that it is. Let's say that we're going to get to 8, 9, 10%, as some people have mentioned. Is there really going to be the appetite to raise taxes for Joe Biden to go at the start of the next fiscal year, towards the end of this year, to raise taxes and go, yes, we need to stop on this inflation because otherwise it's going to cause problems? Yeah, good luck. Good luck getting a politician to raise taxes high enough that they're able to suck that much excess liquidity, shall we call it household liquidity, out of the system. And it's going to be, and it's a similar story in terms of raising interest rates. Okay, you've used MMT to, massage the economy to get things going, but then you need to turn around and you need to manage the inflation that's created, provided that the system works. And there is no appetite whatsoever to do that, because any effort to raise, with the level of debt that the US has, which is approaching pre-Greece bailout levels of debt, any attempt to engage in those kinds of enormous, we don't call them large-scale tax increases, large-scale raises in interest rates to manage an MMT-type economy, are just going to blow the whole thing up anyway.
Yep. Well, we've said, interest rates have to go up or taxes have to go up or both, right? Both of which would be required to tackle inflation. Well, let me tell you what my theory is, right? Because I've got Stephanie's book here, right? The deficit myth, right? Now, I reckon that the Treasury and the Treasurer probably got to about page 42 to 43, right?
Yeah.
Which is the first half, which is how you can create the money, right? What they didn't do is to read on as to how you actually create the winning formula to create an economy that actually can create momentum for the long term. That's what the second half of the book's about, right? So, Josh, read the second half of the book.
Oh, let's hope he does.
I think you should. Well, Tarric, it's been a very interesting conversation. Thanks for your presentation, which was great, and for the discussion as normal. And I guess we'll do it again sometime. There's always going to be more to talk about, isn't there?
Well, definitely. Hopefully I got a passing grade compared with Tony.
Yeah. No, pretty good. I have to say the humour probably could be just massaged a little, but, take lessons from the master. He's been at it a long time.
Yeah. Well, it's my first presentation since high school, so I'm okay.
No, that's good. And, I was relieved to see you didn't quite go down to some of the avenues that he did on some of his slides where I thought he was a bit risque. So well done.
Extra credit. Thanks, mate.
Indeed. Okay, thanks. We'll chat to you again soon. See you soon.
No worries, mate. Bye.
Bye.